All right, good evening, everybody, and welcome to this policy and practice seminar hosted by the UCL Department of Political Science and School of Public Policy. My name's Fergus Green. I'm an associate professor in the department, and I'll be your chair for this evening. So the title of this evening's seminar is The Rise and Fall of ESG and What Next for Sustainable Finance. So I don't want to give a lengthy introduction about the history of ESG or anything like that, but I do, just in the interest of clarity, want to give a sense of what a couple of the different main meanings of ESG that people use are. So ESG, of course, refers to environmental, social and governance risks and opportunities. But we might ask sort of risks and opportunities for whom? And I think that question leads us to think about the two different senses of ESG that are predominant. And so if we think about it from the perspective of some company or an investor in a company, and we'll think about it just in terms of risks for the sake of simplicity, the first sense that we might refer to ESG risks is risks to the financial value of that company itself that stem from environmental, social or governance sources. And that is obviously going to be of interest to an investor in that company who's obviously going to be concerned about the financial value of their investment. But in the second sense, we can think about risks that that company's activities pose to the wider environment or to social goods like social equality or social inclusion, or to good governance. And so, for example, if we were to consider, say, an investor in the oil and gas company ExxonMobil, and say we're considering climate change, and that's going to be probably the predominant theme that we're going to consider tonight, an investor who's concerned about ESG risks in the first sense might be worried about how the increasing impacts of climate change like sea level rise or more intense tropical storms, might disrupt oil production on Exxon's offshore oil rigs in the tropics, and how that might in turn affect its profitability and share price. Whereas an investor concerned about ESG in the second sense might be worried about how Exxon's core product, its oil and gas, contributes to the causes of climate change, and they might also be worried about how Exxon's lobbying activities might obstruct the laws and policies that we need in order to reduce greenhouse gas emissions more generally. And I want to sort of suggest that probably a lot of the controversy surrounding ESG, or at least some of the confusion, stems from people talking past each other by talking about the different senses. And some of that might be deliberate and some of that unintentional. But I think if we just keep in mind these two quite different senses, that might sort of help with some of the discussion tonight. But without further ado, let me introduce our fantastic panel who are going to help us chart and understand the rise and the fall of ESG, at least in some senses, and perhaps think about what might come next. So I'll introduce them in the order in which they're going to give their opening remarks, and I'll just give them a brief bio, and you can look at their longer bios on the event page for tonight. So first we have Maeve O'Connor. Maeve is a responsible investment manager at Nest, where she covers climate and nature themes. So in a sense, Maeve is kind of an ESG investor. Right, and she's previously worked for Carbon Tracker, analysing climate-related investment risk in the oil and gas sector, and also the Bank of Ireland and the European Central Bank. Next, we have Kenza Bryan. Kenza is climate reporter for the Financial Times in London, and she's previously worked as a journalist for the Times and the Sunday Times, and she's also tracked the money behind tropical deforestation in the Congo Basin and Brazil for the NGO Global Witness. And I've certainly benefited from a lot of Kenza's reporting on some of the backlash to ESG and its implications for particular some of the financial sector climate alliances. And finally, we have Dr. Ben Braun. Ben is an assistant professor in political economy at the European Institute at the LSE down the road. And Ben's research interests include the role of finance in capitalism, macrofinance, and sort of the role of finance in the green transition. So each speaker will offer opening remarks for about 5 to 7 minutes. Then we'll have a panel discussion. And finally, we'll open the floor to your questions. A final note before I hand over to Maeve. So the whole session, including the Q&A, will be recorded, is being recorded, and will be posted online on the department's website, our YouTube channel, and our podcast after the event. So if you speak, you will be heard in the recording, but if you don't speak, you won't be. We'll let you know when the recording is available, and we hope that you might want to share it with others. So please let me hand over to Maeve.
Is this okay? Can you hear me okay? Brilliant. Thanks a million, Fergus, and thanks for having me. This is a very timely event. So I work at Nest Pensions. Nest, if you're not familiar with it, is a pension scheme based here in the UK. We manage £55 billion worth of assets for our 13 million members. So that's essentially to say that 1 in 3 workers in the UK has a Nest pension. And most of those workers are low to middle income earners. When I kind of think about what ESG investing is, I think broadly speaking, it's the incorporation of kind of non-traditional factors into the financial or investment process. So traditionally, when you looked to value a company or assess their kind of profitability, you would look at financial and economic metrics like the costs of their inputs, GDP growth forecasts, interest rate forecast, etc. But I think as, certain things start happening, for example, climate change and kind of social issues become more embedded into the policy and financial space, there became to be a bit more of an awareness that there are non-financial factors that can play a material role in a company's valuation or in their profitability. So for the E, kind of the environment sense, if I think of, we're investors in a lot of agricultural companies. So if you look at climate risk, particularly physical risk, if a company we're invested in has exposure to regions that are at risk of drought or of flooding, that's very likely to affect crop yields and therefore the financial performance of the company. On the social space, or in the in the social space, this can often be materialised as kind of reputational or litigation risk. Say if a company is found to have forced labour in its supply chains, which can then kind of crystallise in a financial impact. And then in the governance space, it's about making sure that companies are run to a high standard. You look at things like board composition and the remuneration of CEOs, etc. So I think, that's really what I think of in terms of ESG investing, is the incorporation of kind of non-traditional financial factors into the investment decision-making process. Fergus, in his introduction, introduced me as an ESG investor, and if I am to be a little bit spicy, I would kind of push back against that. And that is because we at Nest, we're an investor, and our stance is that for a lot of companies and a lot of assets, ESG risks are mainstream financial risks. And I think sometimes terming these risks as kind of ESG lends to a kind of othering of them, which can inhibit their incorporation, especially when you get to mainstream, very fiduciary-focused investors who say, it's not my problem to think about climate change. When in fact, it's all of our problems to think about climate change, particularly when you have investments that are at risk. Why does Nest consider these sort of factors in our investment processes? I think there's 2 big reasons. The first is that we are a very long-term investor. Most of our members are under the age of 40. So it's going to be decades before they start drawing their pension funds. I mean, my own Nest retirement date fund is 2065. it'll probably be 2070 by the time I start drawing it by the way things are going. But yeah, so we're really thinking about the value of our investments in 20, 30, 40 years' time. And we're well aware that the world is going to look like a very different place in decades to come. And so for us to ignore those kind of facts would be a breach of our fiduciary duty. The second reason why we consider these factors in our investment processes is because Nest is a universal owner. What that means is that we're an investor with an extremely broad portfolio, very diversified. And basically we have kind of, the health of our portfolio is very much dependent on the health of the global economy. And we know well kind of, when you think about climate change from this perspective, from the top down, we know that climate damages are going to have a significant impact on GDP well into the future. And from the bottom up, what we need to consider is that because our portfolio is so broad, we could have, say, investments over here in the chemicals sector. And if those chemicals companies are releasing pollutants into the local environment, there may be a cost to those specific companies to rectifying their manufacturing processes such that they don't, pollute in the process. But we have to balance those costs to that aspect of the portfolio to the other places in our portfolio where those pollutants will have a material impact. So for example, using the agricultural sector again. So it's really kind of balancing the costs of action in one part of our portfolio with the costs of inaction to another. And that kind of lends itself to what you were saying in your introduction about, thinking about the kind of broad-based impacts of climate change, emissions, etc. Lastly, what I would say, which is also kind of playing into the two senses of ESG, is that we are Nest's investment team, so our primary duty is one of fiduciary, so we have to protect and maintain our members' retirement pots so that they have a retirement and they have an income to retire on or a pot to retire on. But something that's quite core to our values as well is thinking about the world that our members will retire into. So we do consider the kind of wider social impact of these things. And we also think of ourselves, or are very aware of ourselves, as being a systemic actor. And that kind of what we do and the kind of precedents we set and how we interact with other stakeholders in the financial system, which we do a lot because all of our investments are managed by external fund managers, the big investment managers, a lot of them. So we very much are cognizant in what we do in those spaces will have kind of a larger impact. And I'm sure we'll get into this, there's limitations to what investors can do. A lot of what needs to happen is in the real economy, and that'll fall down to policymakers and governments to really push through. But we are aware that our impact does go a little bit further than simply the monetary. And that's what we try and do in our investment processes.
Great. Thank you. Kenza.
Thanks for having me also. I'm a climate reporter at the Financial Times, not far away from here. I've been doing that job for 3 years. And in those 3 years, I think I've seen 3 kind of mini eras of the ESG backlash. And the first one was, I think, the rational era. So when I joined the FT, still kind of bright-eyed and less tired than now, it was still peak ESG. ESG was a bit of a bubble, you could say. It was a buzzword. The Financial Times had just, not so long before, launched a newsletter called Moral Money, and everyone still found all the jokes about can money be moral really funny. And I think the rational backlash against ESG had 2 very kind of separate camps that I had to try to kind of navigate and understand as a newbie to the topic back then. One camp was the sort of activist camp, some scientists, some campaigners, NGOs, who looked at this cultural construct that the financial sector could maybe help save the world. And were kind of intrigued by it and excited by it, but also thought that it was probably too good to be true. So The year before I joined, in 2021, Mark Carney, who now leads Canada and at the time was an envoy for a UN envoy for the climate and a prominent figure in the UK, he had said, sorry, how is this? You can still hear me, amazing. He had said very boldly at the 2021 Glasgow Climate Conference that $130 trillion in finance could be put to the service of basically changing the world and saving the world from climate change. That's a huge proportion of all of the assets at all in the economy, and it seemed unrealistic. And so the first rational camp started asking questions, and they would come to me and other journalists, and we tried to take them seriously. And one of the things we found pretty soon is that a lot of the statements that were being made were simply not true. So these flagship climate alliances of financial institutions that Carney had overseen and become the figurehead of, so the insurers, the asset managers, the banks, they all had their own clubs, and they all claimed to align with these broad UN principles that had also been launched in 2021. And one of those principles was no new coal. And coming to this job, I had no choice but to be literal and to sort of question this kind of thing. No new coal. All of the world's biggest financial institutions said that they believed in this mantra and were starting to apply it as a kind of function of their belonging of these climate clubs. Long story short, it turned out not to be entirely true. Banks and others had started to bring in meaningful coal phase-out policies, and research has since shown that they had actually also meaningfully pushed up the cost of capital for coal. So that idea that they might be able to save the world suddenly started to seem a tiny bit true, but it wasn't as true as these financial institutions were saying. So that was the sort of activist camp. Then there were voices, particularly from red states in the US, that also, under the maybe the guise or the impetus of rationality, were asking their own questions. If it is the case that banks and others' insurance exclusion policies are pushing up the price of coal, and coal is a major source of revenues to Texas or another US state, is that fair under our existing legal construct around competition law, the idea that companies and financial institutions should not collude to change the price of anything, even if it's the world's most polluting fossil fuel. So there were sort of rational questions being asked from that point of view, and letters started being sent in, and every climate reporter started having to specialise in competition law. And there was an interesting fallout from this. So the CMA, the competition authority in the UK, and then European competition authorities had to take this question really seriously. It wasn't crazy. And they started, after quite a few months of sort of reflection, they issued green carve-outs. And they basically said, well, my understanding of what they said is, yeah, maybe there is a competition question to be asked here, but it's okay. We will have green exclusion clauses such that we don't consider saying things like no new coal anti-competitive. So that was phase one. That was the rational mini era of the ESG backlash, from my perspective. The second one was the crazy era, and that was overwhelming and confusing, and I think probably pretty irrational. So Texas, which was one of the red states that had started to make threats back in the rational era, actually acted on these threats, and it sued 3 of the world's biggest asset managers, BlackRock, Vanguard, and State Street. And it said, it's not okay what you're doing on coal. The funny thing is, and the crazy thing is, it wasn't those big asset managers that had shifted the cost of capital for coal. My understanding is it was the banks, and even they hadn't gone particularly far. These asset managers, as far as I understand, just ran passive tracker funds and offered some clients the possibility of excluding coal from some of their investments. But it was pretty small fry and not that impressive or material. So that court case happened. Obviously, Trump came to power. It suddenly became an issue of federal law. The US government put its weight behind that court case. Things got scarier for these asset managers. Suddenly, over the past year, it's become illegal to, as a proxy advisor who advises investors, it's become illegal to think about ESG at all or to talk about ESG at all. All sorts of crazy things have happened. The final era that I've noticed is less exciting, but maybe more interesting, and it's the readjustment, and that seems to be what's going on now. It seems like some of the financial institutions that had gone pretty far and were doing things that were expensive to them have rolled back on some of that. So they've started firing ESG bankers and asset managers and insurers who specialized in ESG rather than the underlying flood risk or the underlying material physical risk. So they've started to save money. They've also cut back on some of the more complex carbon financial accounting. They've put debates such as whether financial institutions are responsible for the emissions linked to things like helping with an IPO or underwriting a bond. All these kind of tricky and unpleasant issues of responsibility, the harder ESG stuff, has been kind of put to one side. One of the interesting things that's happened in this readjustment has also been a kind of more realistic assessment of the geographical spread of ESG. So basically, financial institutions in Europe have stuck the course out a little bit more. Those in Asia have become more and more excited by it. Those in the US have stepped back. And all of those climate clubs that I talked about at the start, the optimistic ones in 2021, they've either collapsed or paused their activities. All of them except the asset owners one that had been set up years before in 2019, before it was cool. The ones with the super long fiduciary outlook, because the pensions don't come good until much later on. Everything's readjusted, excited to see where it goes from here. Hopefully you can shed some light on that. Thank you.
All right. This has been great already. Thanks, Fergus, for inviting me to join this panel. I'm currently writing a book not on ESG, but on what I've called asset manager capitalism. So I want to talk a little bit about why the promise of sustainability that came with asset manager capitalism has not been kept. So directly related to what you just heard, but maybe taking a little bit more of a theoretical perspective on it. There are 3 steps in my argument. Fortunately, they follow a familiar narrative arc, the good, the bad, and the ugly. So bear with me. We'll start with the good. But first, I want to back up a little bit and talk about the corporate governance regime that you learn about in textbooks and that I think asset manager capitalism has to some extent supplanted, replaced. And that's the shareholder value regime of corporate governance. So what was the promise of that regime? I would say that it's efficiency, and many of its advocates have argued that explicitly. Economic efficiency at the macroeconomic level. Shareholders were in charge and supposed to allocate capital among companies by investing in their stock and by divesting from their stock, by exiting their investments if they didn't like what the companies were doing. So the rules under this system were enforced by active shareholders, okay, who had an exit option. In the background here is Albert Hirschman's terminology of exit, voice, and loyalty. These shareholders, even today, pension funds, asset owners, still have the option of supplementing this exit option with the voice option, so becoming, engaging with the companies either behind closed doors or by just simply voting their voting rights on shareholder resolutions. But according to this theory, by maximizing financial return, shareholders also maximize economic efficiency and therefore do the best they can. It's an efficient system that generates growth. The inequality that comes with that system, and even in its advocates wouldn't say that there is no such effect. The inequality should be addressed through other policies, tax policy, social policy, and so on. The environmental costs that come when the chemical firm pollutes and its shareholder is different from the shareholder of the agricultural firm, that should be dealt with by regulation. Now, I would say that this promise has been broken even on its own efficiency terms, but that's a different discussion. I want to move on to the promise of asset manager capitalism, which is a different one, in which, in the heady days of phase one, this promise was explicitly, and Larry Fink, CEO of BlackRock, made it many times, this promise was sustainability. So the E in ESG, very much, especially in the climate context. And at the heart of this promise is this theory that Maeve mentioned, universal owner theory, which in the literature was made very articulately and compellingly by a legal scholar, Madison Condon, but others have written about this as well. And what she argues is that asset managers and also asset owners, such as very large pension funds, don't pursue sustainability or ESG more broadly out of charity, but because they are universal owners. And we have heard the logic. If you are exposed to the entire global economy, or at least the listed part, the stock market listed part, then you want to make sure that the economy as a whole does well, which would extend then to the planet of which the economy is a subsidiary, and you should address, you should push for rapid decarbonization. And this is reinforced in the case of these asset managers, especially the biggest ones, who are index fund providers. As we heard, they have very limited ability actually to get out of companies, even if they do bad things such as coal or just other fossil fuel companies, such as they also mentioned Exxon or Shell. Shell is making record profits in the newspaper today. They are in the indices that these fund providers replicate, and so it's actually quite difficult for them to get out of them if customers, pension funds or you and I, demand these index funds. Anyway, the theory is that these universal owners will internalize negative externalities and act accordingly. And they would have the power to do so because they are very, very large shareholders. Now, the bad. That's the good. The bad is something that I just want to bring up briefly, because universal ownership theory has a sort of less benevolent cousin, which is common ownership theory. Universal ownership theory operates at this level of the entire economy. Common ownership operates at the level of the sector. So, if the same small group of asset managers holds significant stakes in competing firms in the same sector, they will find themselves in a position that resembles the position of a monopolist. They have a clear incentive to allow, or even to encourage, portfolio firms to engage in anti-competitive behavior. Why? They don't care about the profit of an individual firm. They won't push that firm to maximize their market share by engaging in a price war with its competitors. They care about the return from all of these firms together. And that is maximized with monopoly pricing. So this is the same logic, as universal ownership, the universal ownership logic, just applied at the sector level, and there it becomes sort of not, there it's not a positive but a negative. From a common public good perspective. Okay, that's just a parenthesis. We have to move on to the ugly. both of these theories, universal and common, they still assume that asset managers fundamentally care about corporate governance. The ugly part is that I would say they actually don't, or at least put this up for discussion. And I would say that under actually existing asset manager capitalism, corporate governance is actually only one of at least 3 battlegrounds in which these firms operate. And we already heard kind of about the political one. Politics is one, and the other one is the competition for assets to manage. Okay, so that's, and the audiences are institutional asset owners, for example, for whose assets you compete, and then politicians and voters are also audiences. So I would say that the assumption which still prevails in the legal and management literature is that corporate governance is a neatly organized field organized around agency conflicts between managers and shareholders, and the asset managers are somewhere in between, is no longer really a very good description of reality, and that corporate governance has become a much messier, more politicized affair. And this has to do with the fact, partly, that these asset managers are so very large. They operate much like governments in some sense, and so it's no wonder they become politicized. So to conclude, the messy politics of actually existing asset manager capitalism is about navigating the goals of maximizing assets under management on the one hand, while minimizing political and regulatory risk in an environment where, for example, Republicans in the US have identified, woke capital, quote unquote, as an enemy. For the biggest players, therefore, corporate governance has become somewhat of an afterthought, which, in the context of the green transformation, is a very scary scenario, because just right when we need to organize, have a huge economic coordination challenge where we need to organize a massive reallocation of capital, sort of the former command and control room of the economy, the interaction between corporate managers and their shareholders is sort of dysfunctional and disrupted. So we can maybe talk who takes over in that situation.
Okay, great. So I'm going to maybe ask each of you a question, but you can also feel free to follow up on anything that any of the other panelists have said as well. So maybe I'll start with you, Maeve. So you said you sort of rejected my characterization, fair enough, of you as an ESG investor, and I want to explore that a little bit. So based on your description of what you do as sort of taking into account non-traditional financial risks, and you focus on nature and so on, and you gave the example of the agricultural company, we're concerned about climate risks to agriculture. So is that not ESG in the first sense that I described, right? It's just basically, you might call it sort of just enlightened shareholder value, right? It's just about recognizing this wider set of source channels of risk to shareholder value. And so I guess my first is a clarificatory question. Would you sort of, in a technical sense, accept that you're that kind of ESG investor? And if so, you're nodding. So if so, I'm interested in why you're sort of you're hesitant to identify as an ESG, and is that because of the kind of politicization that Kenza in particular talked about? And so, could you maybe sort of, has the way in which you and other kind of colleagues in the industry sort of identify, has that sort of shifted over these 3 phases that, or the last few years, as along with the kind of vicissitudes of ESG in the broader kind of political and investment context?
No, of course, and I was being a little bit facetious there in my rejection of it. I think my kind of gut reaction to being a little bit, to shying away from that a bit as a label, is because I think it lends itself to placing ESG factors as some kind of external, nice to have, othered type of investing. And I think that's been problematic in terms of making mainstream financial actors take these things seriously. And I also think maybe we can get on to the challenges of ESG, but there's a lot in there, and it's a term that's been used for a lot of reasons, or to cover a lot of things. But I think when I think about it, it's like we have an infrastructure portfolio and we've got assets, real infrastructure assets. And if one of those is sat in a coastal region, and again, we're looking at investing in these things for 20, 30 years, and if it might be exposed to sea level rise, to me, that just forms part of your regular, mainstream financial process, when thinking about valuing these things, and less so. And it should be treated as such. And I think sometimes, especially when you speak to people in the industry, and of course now there's this backlash, it can do a disservice to the magnitude of these risks to categorise them as ESG. To your second point, no, sure, well, I said I'm a responsible investment manager. It's in my title. It's not necessarily ESG, but I think I actually, and we can probably come on to this as well, one of the features of this backlash has been a re-entrenchment of these kind of values amongst asset owners and managers who want to differentiate themselves and who want to say, no, we are committed to these things. We don't think that physical climate risks are woke, or, all of these kind of things. And I think what could be a benefit to it is that you have some sort of sorting of the market into managers in particular who are committed to these things. They may not be able to publish them in their targets in their accounts if they have operations in the US or whatever else, but that you have, instead of the large asset managers that dominate the market trying to be all things to all people, that you have particularly European asset managers really committing, embedding and coming to the market with products that have climate and social and governance risks incorporated in them in order to service clients like us, who still maintain it as a core part of our investment thesis.
I just think it might be worth noting that the kind of flattening of ESG to just this is investors' core day job, thinking about risk, climate risk, is financial risk, is infrastructure risk, is credit risk. That flattening is kind of convenient, and it's also, you have no choice. It's not, in the current political environment, it would be very tricky to say anything else. But it's not entirely true. Those risks are not the same thing. And if they were, in a kind of, in a world in which people who work in financial institutions are very clever, then portfolios would be aligned with 1.5 degrees, and maybe emissions would be coming down faster, and that's not the case. We're more on a 2.6 to 3 degree trajectory, which means that's also where our businesses are heading, really, because that's what's driving it. And so I think it's just worth remembering something has been lost from ESG, and it's that hope from 2021 that finance would change the world and would save the world. And finance protecting itself in a way that it is bound by law to do, that it does for its pension holders, with good intentions, is not the same thing as the version of ESG that was going to bend the emissions curve. And there is actually some research showing, and sometimes I'm told by people in finance, climate change might not be so bad for some financial institutions and for some big businesses, particularly in the West. They might do quite well from it, and we maybe shouldn't, think that the risk to the world is the same as the risk to finance, because it's not.
Yeah, very interesting. Yes, so it sounds like it's sort of fair to characterise that the first sense of ESG has kind of just been incorporated into investing, and the second sense has sort of fallen away to some extent with the backlash, to some extent. So I thought it's sort of interesting what you were saying in your opening remarks, Kenza, about the different financial alliances that were built up around climate change and how many of them, they've all basically sort of collapsed or significantly weakened, except the asset owners ones. And do you think that's sort of because the asset owners have these sort of stronger underlying incentives because they kind of tend to be longer term, they tend to be universal owners, and it's a kind of longer standing thing, so they've been more resilient to that? And then my question both to you and to Ben is sort of to what's happened to all the other ones? So what about, so take banks, maybe Kenzie, you could say something about banks, and Ben, obviously are asset managers. So how have the asset managers dealt with, so you said that, the BlackRock CEO was sort of hailing sustainability, and how are they now dealing with the sort of the politics from the Trump administration, Republicans in the US, how are they kind of responding to that? And what does that tell you about what the future needs to be for dealing with climate change adequately? Maybe. Either way, I don't mind.
Okay, that's a big one. So just for context, maybe, so BlackRock, the biggest asset manager. First, maybe for context, I think the distinction between asset owners, pension funds first and foremost, but also sovereign wealth funds, insurers are somewhere in between, on the one hand, and asset managers on the other is absolutely fundamental. They're really completely different entities. What makes this difficult to comprehend is that asset managers manage assets for these institutional asset owners in many, many cases, even though some institutional asset owners have that are large and sophisticated, and maybe you can tell us a little bit about that. I would find it interesting, have reclaimed or never given away the capacity to do their own, basically, in-house asset management. And they are very different entities because asset owners are, they are in a way, even though they are shareholder value oriented capitalists, they are in a way not for-profit entities. They are not for-profit companies whose purpose is to make a profit for shareholders, but whose purpose is to serve a fiduciary duty to their ultimate beneficiaries, mostly pension savers, whereas asset managers are for-profit companies. And their income doesn't come from financial returns. Their income comes from management fees paid for by the asset owners, be they institutional or individual. If you have an ETF share, that would be the fee you pay to the asset manager. So it's fundamentally different. And so if we talk about how these two types of giant financial institutions deal with ESG, they have very little in common. So it's not surprising for me that this part of the ESG movement has survived, whereas Larry Fink said already in the run-up to the election, if I may recall, in the long term, it doesn't make a difference who wins this election. Of course, I know this because it was reported in the FT. Everything I know from the FT. So he said this, and lo and behold, Trump won, and BlackRock intensified its 180 on this sustainability discourse, which it had already begun earlier. And it really, this episode, in my view, really shows how insane, in many ways, ridiculous the first phase of this ESG craze was. It was basically complete nonsense. It was a hype, and these for-profit companies sold ESG funds because there was demand for it. Now, they are told from the U.S. government, and most of these companies are U.S. registered, asset management companies, that they will get into big regulatory trouble if they continue to position themselves and market the products in that way, and so they just stopped. End of story. So.
maybe something briefly on the banks, and then we'll go to the audience.
Yeah, the banks one was quite interesting because there were whisperings of discontent in the banking group before the political backlash really started, and that was because these climate clubs had their own kind of architecture of accountability for the financial sector. So they said, if you're part of this club, you have to be on a net zero trajectory, you have to do legitimate financial accounting. I think they had to be 1.5 degree aligned, which just means be a bit more ambitious. You have to disclose, you have to report. It was quite tough. And already a few years ago, big US banks were pushing back against that, and they wanted the name, but they didn't want the accountability. And then things just started going south when they came under more pressure last year. The threats, it was a strange one to report on because they would drop out one by one. And then all the banks that are part of this group voted to only now align with the 2 degree world, which is more realistic. And that wasn't enough. And it has more or less folded now. But what some of the European banks, for example, who were in it, highlight is that that architecture of accountability hasn't gone. They now disclose that every year. So in some ways it achieved its purpose to rationalize some of the chatter that was happening in the early days.
Yeah, I actually had an engagement meeting with a very large bank last week with their CEO, and the NZBA, which was the banking climate group, was a matter of discussion, and he pretty much said the same thing, i.e. We've reaped the benefits of it, or we reaped what benefits there were to be gained from it, and once the large US banks started to drop out of the alliance, there ceased to be any kind of marginal benefits to being in it because they lost the collaboration. But, you know, and this may be down to the group of investors that were in the room with him, but he was very adamant, excuse me, that they remain committed to those commitments that he put forward. We've also heard the same from all of our fund managers who have had to drop commitments publicly due to the political pressure that they face. No, I'm not so, green behind the ears that I'm not approaching these things. A little bit of skepticism, but it seems as though there is sufficient client demand from the asset owners that, there will be some of this stuff continuing on amongst asset managers, even if they can't speak to about it publicly. I definitely agree that some of the targets, and there was a sense of exuberance about all of this stuff in kind of 2020 and 2021, and I think it's kind of one of the positives of the backlash is that we have to revisit what we're doing, really kind of drill down to first principles and figure out what's, one, within our remit, and two, what's doable, and three, what should be done. Because, as we've kind of all said, there's only so much that the financial system can do in this big transition that we need to undertake.
Okay, great. So I will just sort of note for the record that there's a lot of evidence that the largest banks in the world are still ploughing like hundreds of billions of dollars into fossil fuels, including new fossil fuels. And so this is something that critics have highlighted as well, particularly for banks. But let's now hand it over to you. So I'll take questions in groups of 3. So hands up if you'd like to ask a question. Okay, so let's start with these two here. Yeah.
Good to go? Okay, thanks very much, guys. Really, really informative. I'm just wondering, what's the picture in other parts of the world, particularly the Far East? I'm thinking China, but I'm also thinking Japan, in terms of the trends you've spoken about, so the rise and fall. Do these still hold true in the same way? Bearing in mind investments are sometimes targeted in that part of the world. And also, considering that, do some of the future pictures, does that look the same from that part of the world as well, or is it entirely different? Bearing in mind, based on what I've heard today, a lot of your thinking tends to be based on what's happening in the United States or Europe.
Right behind
Hi. So I'm not sure if you guys are familiar with this, but Bill Gates very recently issued a memo about climate change and investments related to climate change. So one of the things he said in the memo was he criticized excessive resource allocation towards climate change initiatives, and in his opinion, money is better invested in initiatives to take people out of poverty. That saves more lives compared to spending money on climate change initiatives. So I guess my question is, what is your opinion on this?
And then one more sort of hand over there, yeah. Just hold on to the microphone.
Thank you so much. That was very informative. I just had a question because you said that now traction around ESG is very much in decline. In a world that seems to care less and less about the environment and about like preserving like all of these different policies that act towards the betterment of climate change, how can ESG become, I guess, trendy again or like desirable? Maybe can it be shifted towards, as someone else over here said, towards more rising economies that would actually benefit from it? So for example, instead of making kind of the USA the center point of it, maybe we should, I guess, or maybe it's already happening, I don't know, but maybe we should shift it more towards like developing economies like China, India, and all of those different places that have a lot of potential.
Great. Okay, so I think the first and the third question certainly quite closely related there. So maybe we could ask our panel to sort of take both of them together. I mean, I seem to recall when the Glasgow Financial Alliance that we've been talking about sort of changed fundamentally, they sort of talked about how, by kind of weakening our criteria, we can engage more with Global South, and that was sort of part of the rationale to some extent, wasn't it? But yeah, anyone who would like to take that. Yeah.
Yeah, and they were right. And the membership of those organizations has grown in Asia and the Middle East and Africa. So that was true. I mean, the obvious thing to say is that clean energy is a growth story in China in a way that maybe it's less so in the US and more stable in Europe. So with that logic adopted by some financial institutions that, they just track the economy, then there will be more funds that would previously have been labelled ESG, but they might just not necessarily need that label. So almost more of that neutral language of growth and clean growth, because that's kind of what's happening. And just in terms of making ESG trendy again, I'm not even sure, it needs to be trendy again, but if it were to be trendy, I think maybe there'd be two ways of doing it. One is, as extreme weather events become more frequent, I'm really interested in the idea of whether central banks will start to see climate risk as a financial risk in a really serious way. And if they did, I think it would follow from that financial institutions should go beyond this tracking of the world economy and should actually maybe try to shape it in a way that is kind of, revolutionary and would be very new. Yeah, over to someone else.
Yeah, thanks for these questions. Maybe on the question on China, I would ask back, why are we so fixated in a way on ESG? Why is ESG such a big part of our discussion on on how we finance the green transition and what finance can do? And I would say, well, it's because we live in an economy in which decisions about capital allocation are taken by pension funds, banks, and asset managers, not by the state. That's not the case in China. there are funds for sure, but they're called government-guided funds. And they are guided by the government. And if the government wants to build out its renewable energy industry, the government-guided funds that operate like venture capital funds in the West, just the same, but instead of freely deciding on their own that they want to, let's say, build a powerful industry of tech giants who sell ads, they will build a powerful industry that makes renewables or builds an electric vehicle industry. So, if we talk about ESG at some point, we have to talk about the gaping hole some of this discourse fills, and that is lacking state capacity, in my view, to take on, this coordination challenge of coordinating a huge investment challenge on the one hand, but also a huge decommissioning, phasing out, asset stranding challenge, and the private sector is in no position to strand assets. It's the state does asset strand.
One thing I would add about making it trendy again, and I'm glad you said it, because I think sometimes with headlines out of the US, there's a little bit of a case of letting the tail wag the dog, in terms of, we take, there's quite a dismal global view of ESG, whereas really that's kind of a narrative that is being set out of the US. But I think in terms of making it trendy as well, we're starting to look a lot more at investing in the UK. We've signed it to the Mansion and House Agreement, which is a government initiative to get more private investment into the UK. And there's lots of really cool opportunities there, and it's something that we like a lot because our members can see it. And there's a huge amount of opportunity in the UK. Last year, we invested 1.4 billion into renewable energy farms, wind farms with Octopus Energies. And at least for the kind of small interactions we've had with our members, they thought that was pretty cool. So, to look at home and initiatives and, really play ahead with the UK's own decarbonisation trajectory is something that is a real opportunity, I think, for the industry.
Okay, great. Let's take another round of questions, please. Well,
We did answer the Bill Gates one.
Oh, yes. True. Does anyone...
I don't... Who else was it? Yeah, so that's what you're saying, that yours wasn't answered. Yeah. I'm not sure he was... I think he might have been wrong when he said it's not about every 100th of a degree or every 10th of a degree. It's about... Sorry. It's about malaria shots, or it's about vaccine deployment. It's an interesting...
That was just kind of an example of what he would prefer. He was trying to say, between the choice of reducing temperature by 1/10 of a degree versus some amount of malaria prevention.
Yeah.
Take malaria prevention.
No, and it's an interesting utilitarian argument, and it's convenient for, in Trump's America to make an argument about health over climate change. But I just wanted to make the point that I don't think it's true. I think every 10th of a degree, or it's at least worth challenging, every 10th of a degree means a lot of lives lost.
It means more malaria.
Yeah, well, that's right. That's right.
And more tropical diseases of all kinds, yeah.
Yeah, I'm not familiar with the memo, but it sounds like an echo of an older debate provoked by a book called The Skeptical Environmentalist by a Danish economist called Bjorn Lomborg. Is that? Yeah. And he basically sort of surveyed a bunch of economists to say, well, how could we get our best bang for buck in terms of human welfare and, development, investment, and so on. And he was not sort of denying climate change, but he certainly, the way he characterises climate change has been challenged by a lot of climate scientists, but he sort of made a similar argument. And often it comes down to the discount rate you apply to future, because there's a huge amount of climate impacts already, but the worst climate impacts are going to come in the future. And so if you apply a high discount rate to sort of to future value, future costs and benefits, then you're going to value these sort of short-term interventions a lot more. So maybe have a look at that debate and some of the critical responses to Lomborg. So, okay, other questions? Yep, the back. I'm going to start eyeing some of my students if no one else asks a question. Looking over this side of the room a bit. Okay, one over there. Yeah.
Just to the comparison with China, I mean, does that, at a time when the West is allocating vast amounts of capital to a massively energy-intensive industry, i.e. AI, and is yanking capital away from the likes of Ørsted, which was an oil company which transformed into a wind company, does the comparison with China suggest that essentially capitalism can't deal with climate change, or is it just a flavour of capitalism that we currently operate in?
Let's take a couple other questions. So I saw a hand over here. Yep.
Hi. I had a question about, so you mentioned in the US how recently the Trump administration has been creating new regulations that basically ban ESG considerations in certain investment types. And I'm just wondering how that's operationalized in terms of what specifically is banned, and then in terms of what could be done with a future regime if there is a more friendly to environmental concerns regime in the US, how that would be operationalized, or what kind of vision we could have for a better way, from a regulatory perspective, how we could take those, make those considerations and make them into actually binding rules. Yeah. Thanks.
Any others? Otherwise, we'll take those. Yeah, at the front here.
Thank you so much for your time, for coming here and the presentation. I just wanted to make clear if you see this as a collapse or a correction of the ESG. Do you really believe that we are witnessing a collapse of the ESG as a meaningful framework for the sector? Or is it simply just a market correction that after years of unrealistic expectations and greenwashing, it has to be done?
Brilliant. So, feel free to address any of them, but I sort of felt like the first one maybe went fairly naturally to Ben about sort of can capitalism solve this problem, or this kind of capitalism? And then Kenza, maybe Annabelle's question about banning investments. Again, respond however you wish, but I thought maybe that sort of relates nicely to some of the US states and the decisions that they've made about sort of blacklisting certain funds and so on. And maybe is that something that we want to encourage? Do we want the Democrats to do that if they ever get back in, if the US ever has elections again? Or so maybe you could talk to that, and then maybe Maeve, you could speak to this last one. Is this a collapse or a correction about ESG? And if we're reasonably quick, we might get another one or two questions in as well. Ben, do you want to start?
All right, I'll try to be reasonably quick about whether capitalism is unfit to address the climate crisis. It looks like it is, I would say. But more specifically, maybe, I said, the private sector is not good at asset stranding. I think this is pretty clear. So we need the state to strand assets. Now, why may this be particularly difficult in the kind of capitalism we have? There, I often come back to the example, actually, of pension funds. Not because they are bad ESG investors, but because of the structural difficulty even for the state to, let's say, legislate coal and fossil fuels out of existence, or at least make them economically unviable, so that the pension funds can actually divest or so the values of these shares simply go to zero, even if it hits their portfolios. And it's because this is a large part of the economy, and so many actors, including pension funds, are invested in them. Okay, so stranding large parts of an economy in which all of our pensions are bound up, and it's not just fossil fuel industries. It's also, for example, a German car industry. I'm German. Trying to keep these sectors alive is a constant temptation for governments, regardless of exact, shape and form of the polity, because so many material interests are in there, and it's maybe a temporal horizon problem, but it doesn't go away. And the fact that we have so many layers of investment, financial investment in these existing assets, makes it, in my view, more difficult. But there's no obvious solution. You can socialize these pension funds, you can nationalize them, the investments would still be there, and the political economy constraints would still be there.
I think if I was to just add to that, so there's definitely, obviously, operations that need to cease, like fossil fuels, etc., for climate change. There's also operations that need to change. And I think there's a really big role for governments to step in there and be market makers for these kind of new technologies that we need. Like, I spoke to a German cement manufacturer recently, and they have developed the capacity to produce net zero cement, which is massive because cement is an extremely large source of carbon emissions, and we obviously aren't going to stop building buildings. But what they say is that, well, a unit of net zero cement is far more expensive than normal cement, and the only customers that we've been able to secure thus far are governments who are building municipal buildings and have their own net zero targets to hit, and so absorb the demand for that. And as they kind of get better, learning by doing, economies of scale, the beginnings of that market being fleshed out by governments and then being taken up eventually by private actors, I think is a really important tool in this kind of toolkit for decarbonising sectors that we need to keep.
On the question of what Trump's actually done on ESG, I think the rollback of Biden's IRA package of green subsidies is maybe in a way more relevant by just changing that landscape and making it less attractive to invest in clean energy. In terms of concrete stuff, what he's done on ESG seems to be very aesthetic, and I don't know whether there's been research yet showing how far the aesthetic stuff has trickled down to a shift in assets. So within his own administration, you have to talk about coal as beautiful, clean coal. That's like an aesthetic shift. To the extent that these climate clubs were quite aesthetic, the banks coming together and asset managers coming together to talk about the idea of phasing out coal, they can't do that anymore. That's colluding. And then something that I think maybe could have really quite maybe more of an impact is the idea that these proxy advisory companies that advise investors and asset managers on how to vote their shares can't talk about climate risk and biodiversity risk, really. That's my understanding. So that seems like the most outright ban on, but again, that's language, so it depends how important you think language is in shifting cultural norms around investing. But that has had serious knock-on effects, and the two largest ones have either stopped having a house view at all, or watered it down to such an extent that it will just be less impactful. And in the last proxy season, there wasn't a single environmentally themed resolution voted through. I'd be interested, what's the research on how material and impactful that kind of thing is, and or maybe something that's more realistically could have been researched already, these shareholder resolutions, how far did they shift the dial in previous years when they were being voted through by the dozen?
Yeah, I'm not sure I have a precise answer to that, but so the effect of, the material effect, let's say, on emissions or whatever, of shareholder resolutions, I'm not aware of any research there is research that show that the most universal shareholders, BlackRock and Vanguard, the big index fund providers, were laggards in voting positively on climate-themed shareholder resolutions in the past, and that other smaller, less universal, quote-unquote, asset managers and insurance companies were much more supportive of these shareholder resolutions. Yeah.
Anyone want to address the sort of collapse or correction question?
Yeah, I think I made the point throughout that I think this is very much a correction rather than a collapse. At least that's what I've, it's an impression I've gleaned from speaking to banks, to asset managers. But actually on shareholder resolutions, I think another kind of correction is, and I previously worked for an NGO and a think tank, so I think I'm allowed to say this, is that there's a bit of a correction in that space as well. And during the kind of, exuberance of the early 2020s, you saw maybe 10 climate shareholder resolutions filed at places like ExxonMobil. A lot of them with very good intentions, but it fragmented the vote, and I think now we're looking at even those kind of stakeholders going back to the drawing board and thinking even more about kind of working together and filing one really pertinent, strong shareholder resolution, as opposed to a bunch of NGOs who we all need our funding, or they all need their funding, so they're all going to file one at the same time. And I think we're all going back to the drawing board and figuring out what's material in this.
So maybe time for one more question. I saw a few hands going. Yep, just here. Great.
Hello. So I have two questions. One is, sorry, I have read different papers that is talking about one of the cons of the capitalism in the sustainable finance market is they will lead the sustainable finance become an opportunistic investment. So so based on Dr. Brown, your paper that is talking about the asset manager, they actually have the political economic power to try to benefit the sustainable finance market. So just based on the opportunistic investment cons, do you think the asset manager can actually do something or have that relatively large power to try to guide the sustainable finance market rise again? And I also have another question. It's about how do you think about the environmental authoritarianism approach in Singapore or China for them to develop a sustainable finance market? Because some of their advantage of this kind of market did solve some of the cons in the capitalism market. So I want to know how do you treat this one and how do you look at it? Thank you.
Okay, so we now have 1 minute to answer maybe just one of those questions, and maybe give everyone a sort of a final observations or related to that question or otherwise. Maybe start with Ben, seeing as it was addressed to you, and we'll come this way.
All right, sure, yeah. To the first question, I don't think that the impetus for this will come from asset managers, if anything from the asset owners. And on the second question, I would just repeat what I said earlier, that in a way, I'm not sure about Singapore, but in China, there is, in a way, ESG system, financial system in place that operates in a different way, and that is much more, I would say, organically connected to or embedded in the industrial policy, green industrial policy architecture, which is vast and complex, but seems to be working.
Don't feel compelled.
One thought on Singapore and its proposal.
Are you muted?
Oh, sorry. I'm stuck in 2020. Quick thought on Singapore, and its carbon tax scheme, playing with the idea that could be considered authoritarian. Really, it's it's what the EU led the way with, and in a way, it's a great response to that, making sure that any revenue raised from the carbon tax goes to Singapore and not to the EU through the carbon border adjustment policy. And then it's been incredibly innovative in saying that companies can use carbon credits to pay some level of that tax, but it's still, I think the price is still pretty low, much lower than the EU's. So be really interesting to see how that develops and whether it ends up rising to meet the EU's carbon price, which is so ambitious. No, but great questions. I don't think I can answer the first one.
Great. Well, I think that sort of brings us to the end. So before we thank our speakers, I just want to remind you of our next Policy and Practice event. We'll be taking a break next week because it's reading week, but our next event will be on the 13th of November, and it's on the subject of women, peace and security in conversation with Helena Carreras, who's the former Defence Minister of Portugal. So please come along to that. You can sign up for it via our website. So, thank you all very much for joining us, and please join me in thanking our speakers.